Now, this is when we pivot over to what is happening in the US. And as you can see from our favorite chart, looking at the key mobility fuels, gasoline, jet, disti, resid, you can see that we still are underwhelming. We're tracking very close to where we were in 2021. And realistically, that's going to continue to be the case. And it's actually surprising us to the downside. We were expecting to be a bit closer to about 14.1, or at least trending towards that. But here you can see that the average for the week was at 13.625 versus last week at 13.8. So we're still hugging pretty far below that 14 million barrel a day number. Now, it'll continue to trend higher. As you can see, every year there's a trend up until about February. And then you either have February break, which is also known as spring break, and it's either in February or March, depending on the school you go to, or on an elementary school side, or middle school, or high school, or obviously college. And that's usually where you get another bump in terms of activity. But you can see that normally happens. There's a slowdown, and then you get that nice increase. And that starts to kick off some of that activity. And then typically right around Easter is when you start to see the bigger increases in activity, as you get towards the end of April. Because in May, as we go into Memorial Day, that is the start of the driving season. But you can see just how low we're starting, and we're not getting too much to the upside because we don't see any real recovery on the diesel front. Obviously, it will in the near term, you'll get a benefit from weather, but we don't see much change on the trucking front. And then on the gasoline side, prices going up. We don't, and weather being inclement, we don't see that we see that coming down, and again, kind of keeping us at a fairly reduced rate. So now when we look at distillate draws, you can see that there was a draw of 510,000 barrels. That's still 28.1 million below the 5-year. But when you look at it, again, it leveled off, and things have, there's been more aggressive times of draws. We had a sizable increase in imports, which is going to continue based on the barrels that are being redirected from Europe to the U.S. and the East Coast. Here you can see there was a big increase of 196,000 barrels a day coming into Pad 1, increasing total by 172,000 barrels a day. But there is still a draw in Pad 1 even with that. And as you get cooler weather, especially in New England, especially if you look at the U.S., which we're going to show in a second, you're going to get additional draws on the heating oil side, while diesel on the trucking side continues to be an overhang. So there's a lot of push and pull, which is why we expect to see storage stay fairly stable. It's going to continue to the downside. We still see draws, but you can see that a rate of change is going to be really important because we normally draw this time of year. And the question is going to be, how far do we draw down and where, which is really going to drive some of those economics. The fact that Pad 1 still remains on a seasonal low level is going to support additional imports, which is why we've seen that competition in the Atlantic Basin, moving some of those cargoes from Europe to the U.S. And for those that have been watching us, that has been our base case, where you're going to get more competition in the Atlantic Basin. And as the U.S. continues to export distillate, especially into Europe, that'll put and pivot more of those international cargoes into the East Coast. You had a bit of a recovery in some of the crack spread on the diesel front. It went above 60, but now it's still back to that 57, 58. And we see it just living realistically in this world, especially given where storage is, leveling off. Demand on the diesel front still remaining fairly lackluster, but versus historics, it's still very high. And that's because storage is still historically very low. The gasoline is going to be the pivot on how profitable a refinery is going to be in the U.S., abroad, and those are going to be some key focal points over the next few months. Distillate in Pad 1, you can see that it's still at a seasonally adjusted all-time low, but the rate of change is flatlining, and you could see that there's typically a sizable drop during this period until you get to really the middle to end of March, and then you start to see those builds. Realistically, these imports will help buffer, which will soften the rate of change. We still are going to get draws. We still have colder weather that's going to accelerate this, and that's going to be an important thing to watch over the next few months. Pad 3, a bit on the lower side, but you can see just above the 29-year average. The movement is going to be balancing it between what is going into colonial, what is going to the international market, and we expect them to maximize everything going to Pad 1 and everything that they can going into the international world. When you look at distillate products supplied, here you can see that demand in the U.S. continues to disappoint. We expect it to remain well below the 5-year average. It'll bounce from here just based on weather, but again, we're going to see that stay fairly far below the 5-year average within the cloud. Like, it's not like we're going to set new seasonal lows, but it's definitely going to be a pressured market. And here's another piece where you continue to see some of the slowdown in trucking. One of the things that we've talked about is we expect it to be, in this range, if anything, a little bit higher, probably closer to 47. You saw that the load availability came back up. That'll support some of these increases on the market demand index side. So again, you're just kind of running stable here, and you're seeing what that looks like. So the swing at this point is going to be weather, which has pivoted a bit cooler. On the rail side, you can see that things have improved on total car loads, but it's important as to where, because chemicals still remain weak. That's going to continue. When we look at coal, going to stay strong. Farm grains that will remain fairly elevated versus historics. Maybe not as good as some of the previous 2 years, but still on the strong side. Metallic ores is going to continue to be fairly elevated with motor vehicle, non-metallics. And you're starting to finally see that bigger pickup in petroleum and petroleum products. That's going to remain elevated. But intermodal, small bounce, but intermodal is going to be a big overhang. The benefits are going to be in coal, grains, and a bit on the petroleum side as intermodal continues to have that overhang given inventories, slowing consumer. So that's where when you're looking at, okay, well, if I want to express this in a position, who's the most exposed to the intermodal markets? And you're going to see that continue when you look at what is coming to our coast. When you look at what's coming to our coast, you can see that there is a big problem and a strong what is coming over the really through February. And here you can see the slowdowns, what's in berth, what's heading our way. There continues to be another problem when we're looking at activity, and it just shows that there's going to be more issues as we progress through the quarter for the most part, just because there's slower orders. When you look at new export orders, new orders in China, in Asia, when you look at it in the U.S., there's not a lot of strength. And then when you look at the manufacturing PMIs that we talk about in the Econ show, we'll talk more about it again tomorrow. You can see that there's even more pressure, which again is going to keep that activity reduced. So here's where you can see it's getting colder, and a lot of this cold front continues to press to the west to east. So you can see that things are going to dip again, and that's going to bring a lot of new snow, a lot of inclement weather, and that freeze off where people just won't want to do as much, and that's going to continue to progress west to east as we've seen that move. That's going to support some of the natural gas consumption, which we've seen already with some of the data sets, as well as some heating oil, and that's going to provide a little bit of an uplift. But again, the diesel front on the trucking side will remain the underlying overhang. Gasoline stockpiles bounced another increase of 1.76 million. You can see that's still 19.3 million below the 5-year. And the rate of change is important, where the rate of change is kind of tracking where we've been over the last 29 years, but it's still below where we've been previously, and a lot of that is going to be driven based on some of those slower imports. Pad 1 had a build of 2.32 million. Pad 3 small draw, Pad 2 small build. But when you look at it, Pad 1 and Pad 2 are still fairly light in terms of the 5-year average, which is driving this, where Pad 3 is a bit more stable, especially as you go into Pad 5. But imports were down 105,000 barrels a day, just below the 5-year average. And it's just going to be a matter of where are the economics coming from Europe into the U.S. Europe still has a record amount of gasoline in storage, and we're just not seeing it come into the U.S., even though there's more than enough room when you look at the storage data sets. But we also have rising prices, going to put pressure on demand. And that's, we're going to see this kind of leveling off, and we should see this look in terms of rate of change similar to the 29-year average. But we don't see a big draw going into March at this point in time, especially into March and April, which is going to bring those comps back in line, and on a 5-year average level, going to be fairly normal. Now, this is what gives us a bit of confidence in saying that is the blending component side. So blending components had a build of 2.2 million, which is only 10.8 million below the 5-year. A lot of that is driven based on, slowing petrochemical demand, a lot of, this reduction in terms of U.S. demand. And we do expect to see that accelerate. And then we see the rate of change being a bit more aggressive on this side, which is why when you look at storage in the U.S., this typically is a bit of a leading indicator for storage. It's going to push storage a bit higher. It'll likely go up just above 2 million this week into next week. It'll all depend. Obviously that can change with if we get a big drop in imports. But these are the key pieces to watch, especially when you look at exports going into the market, which remain well above the 5-year average. So you're seeing this balancing act where it's like, okay, well, demand isn't great. So storage is okay, and fairly a little bit on the lower side, but exports are setting new seasonally adjusted records, still well above the 5-year average. So there's this balancing act going on, and it's going to be specific as to location and price. Gas Buddy, here you can see that they modeled just below 8.03 million barrels a day of demand. Again, there's still that slowdown. It's the EIA had it. Now you're seeing it in Gas Buddy as well. There's a little bit of an increase, but again, the weather is going to push that. If the weather continues the way they're forecasting, we could break below 8 million barrels a day. There could be a bit of a rush to fill up ahead of the storms, which would give us a little bit of a bump, and then a big fade as people have already filled up. They don't drive because of the storm. So again, that's why we always talk about the importance of the 4-week rolling average. But the past 4 weeks have been fairly lackluster and averaging, just below 8 million barrels a day, which I think you can see here. So when you look at Asia Pacific, coming down just a bit, China, which isn't on this chart, I'm going to talk about it a bit more on Friday, and then tomorrow as well. So China had a spike above the 2019 average and now a big drop. But a lot of that is seasonally normal just because you have the Lunar New Year, you have the vacation period. You can see Europe, flatlining just a bit. It was just below the 2019 norm, as North America continues to be well below average. And when you look at the 4-week rolling, in terms of the different locations, Asia Pacific just below 0.6, Europe 2.3% below, North America about 0.9. And then when you look on that's on the week, then year on year, you can see that Asia ex China up 4.6, Europe up 2.1, and the US again slowing down just a bit on the 0.6 side. So, same time periods in terms of the 4-week rolling average versus Jan 14th, but going back a year, you can see that we're about 16% below normal. So it's balancing, and it's just we're balancing at a reduced rate. And I think that's the biggest problem at this point, is because on a year-on-year level, and not to say that 2022 is a great year, it's just we can't even get back to that level when you're looking at some of the different pieces. And then when you go back to 2019, you can see that we're still, again, well below what we have been at this point in time on the North American front, which is the biggest concern. But you see it leveling off, and that's what we've been talking about with work from home, flexible schedules, and that becoming a bit more of a consistent. And obviously the rising prices doesn't help. So you can see that there's been a sizable spike in gasoline prices. It's obviously well below where we were in 2022, but when you compare it from 2018 to 2021, it's the highest it's been from 2018 to 2021. So you're still expensive, versus previous periods, and now you're getting diesel flatlining here. And that's what we talked about last week on diesel. It's like we see some stability at this point just because you do have some colder weather, you do have some, storage is still at the low end, and then on the gasoline side, you're starting to see some of those increases over the across the U.S., which is going to be something to watch when you start talking about, what is happening on inflation, those month-over-month numbers. That is going to have a bit of an impact. While demand continues to be very lackluster, as you typically see a spike and then a bit of a sideways and then another spike, we just are saying that the next increase is going to be underwhelming. It's going to likely split between 2021 and 2022 in terms of where we sit at this point in time as the pressure remains on the consumer. Then when you look at propylene, small draw of 1 million barrels, but again, that's 14.8 million above the 5-year. You can see that the rate of change is softening, and it's just there's no real demand from the petchem side, and it's been warmer. As it gets cooler, this will accelerate some of the draws, but you can see that we're still in a very bearish backdrop, which is going to push down pricing and keep our exports accelerated. Jet had a build of 1.15 million, but then when you look at demand is just above where we were in 2022, and it's just at the low end of our range. But again, we still think that range is going to hold firm. When you look at TSA checkpoints, here you can see that on the 4-week rolling average, we're just below where we were in 2019 levels. Europe is a bit worse. We're about 87.3% below of 2019 levels. So things in the U.S. are getting back to normal. But as we've been saying, even though the passengers are normalizing, the flights are not, and they're just stuffing people into those flights. And then when you look at Europe, there's remains additional pressure. And here's where you can see against the seasonal, increases, things are fairly stable versus the previous years, but again, that we just still see an overhang for jet fuel demand given the reduced amount of actual flights. And then that's reverberating with reductions in Europe, reductions in other areas of the world. Then you look at open table, the U.S. continues to decline. We expect it to be a bit of an overhang just as costs go up, inclement weather. So again, just as you can see, things are staying a bit, just about where they were globally speaking versus previous. But the U.S., we see some additional levels of pressure as we go into the rest of Q1, and then we should see a bit of a bounce as we go into Q2. So that's what we have for you on the U.S. consumer, on the U.S. side. In the next segment, we're going to go deeper into the international markets and what's happening with Russia and abroad, crude purchases.